Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Insight Digital Partners 2.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine handing a stranger a wallet with over $170 million in it.
Right, just a massive pile of cash.
Exactly. And you tell them, go shopping for a company. And the crazy part is, even if they completely fail to find one, you still walk away with a profit.
Yeah, it's a completely counterintuitive concept.
It really is. It's almost bizarre. But that's the reality of Insight Digital Partners to Second. Today, we're really focusing on decoding this pre-revenue shell company because they've amassed this huge war chest to hunt down a high-growth business in the digital economy.
Right. They're targeting sectors like payments, crypto, high-performance computing, or energy.
Yeah, and we need to dissect the highly asymmetric risk-reward setup this presents to you, the investor. Because honestly, looking at a company with literal zero revenue, it just requires a completely different analytical toolkit.
It absolutely does.
Yeah.
I mean, the contradiction of a zero revenue valuation, it's entirely by design here.
How so? Because usually, zero revenue is a massive red flag.
Well, when you're analyzing a traditional tech startup, right, or a blue-chip manufacturer, you're looking at product sales, service fees, quarter-over-quarter growth, all that standard stuff. But Insight Digital Partners 2 operates under a totally different framework as a special-purpose acquisition company.
A SPAC.
Exactly, a SPAC. So it is fundamentally just a structural shell. Its singular purpose is to hold investor capital in a highly regulated environment, while the management team, searches for a private operational company to take public through a merger.
Okay, so to make this mechanism tangible for you listening, think of it like hiring a highly specialized personal shopper. You give them a mandate, like go out into the digital economy and buy a foundational infrastructure company.
That's a great way to put it.
But the key condition here is that if they can't find a suitable target within a specific time frame, you get your money back. But I got to challenge the premise here for a second.
Sure, go for it.
From July 11th through December 31st of 2025, they reported literally $0 in operating revenue, not a single cent. For an outsider looking in, parking capital in an entity that produces nothing sounds less like, strategic investing and more like just setting your money on fire.
Yeah, I get why it looks that way. But the underlying math changes entirely when you look at how that capital is physically stored.
Okay, walk me through that.
So that $172.5 million they raised during their October 2025 initial public offering, it didn't just go into a normal corporate checking account.
Right, so they're not using it to fund lavish executive retreats or whatever.
No, not at all. It was immediately deposited into a strictly regulated U.S.-based trust account. And while the management team is out hunting for an acquisition, that massive pool of capital is sitting in interest-bearing instruments, typically short-term U.S. Treasury bills.
Oh, wow. So the capital is generating its own yield while the team does all the heavy lifting?
Exactly. That is the fundamental engine driving this entire structure. Just to give you the numbers, for the trailing period ending December 31st, 2025, the capital in that trust account generated $1.16 million in interest income.
That's significant.
It is. Now, compare that yield to their general and administrative expenses, like the actual costs of running the search, paying the lawyers, conducting the due diligence. Their cash burn for that same period was only $267,000.
Wait, the math on that is just wild. So they are pulling in, over 4 times as much in interest as they are burning on operations?
Yeah, they posted a net income of almost $900,000 without selling a single product.
That's incredible.
Right. The entity is entirely self-sustaining. The yield on the trust aggressively outpaces the corporate burn rate. And on top of that, the management team ensured the trust remains untouched by raising an additional $5.45 million.
Ah, right. Through a private placement of warrants at $1 each. Let's break down the mechanics of those warrants for a second, because I know that sounds like financial jargon, but it's actually crucial to the incentive structure.
It's extremely crucial, yeah.
Because a warrant is essentially a contract. It gives the holder the right to buy a share of stock at a specific price at some point in the future.
That is a perfect way to conceptualize it. So the sponsors and underwriters actually bought these warrants with their own money.
Which injects that $5.5 million of immediate operational cash directly into the company's working capital.
Precisely. It covers all the legal and accounting fees associated with finding a target company. So by doing this, they guarantee that the main $172 million trust remains pristine, It's fully protected for the common shareholders.
That's a huge safety net.
It is. Furthermore, those warrants only become valuable if the eventual merger is highly successful and the stock price climbs significantly. So it forces the management team to put their own skin in the game.
Okay, so that significantly de-risks the profile for a regular shareholder. Your principal is shielded, the operational costs are subsidized by the sponsor's upfront capital. But this brings up a pretty glaring question, I think.
What's that?
If the structure is this secure and self-sustaining, what stops any random group of finance guys from setting up a shell company, raising $100 million, and just collecting the treasury yield? Like, what is the actual competitive advantage, the moat of this specific company?
Well, the moat has absolutely nothing to do with the financial structure itself.
Really?
Yeah, I mean, the shell company is just a standardized legal vehicle. Anyone can theoretically set one up. The true moat here is the sponsor's track record, their reputation, and their proprietary network.
So you're betting entirely on the jockey, not the horse.
Exactly. Primarily because the horse hasn't even been identified yet. Finding an undervalued, high-growth target in incredibly complex fields like digital assets or high-performance computing, that requires deep industry connections that most people simply do not have.
Right, the personal shopper actually needs to know who holds the keys to the private deals.
And the CEO of this entity, Michael Singer, has a proven, verifiable pedigree in this exact arena. He previously led a similar vehicle, Insight Acquisition, which he successfully navigated through a pretty complex merger with Alpha Modus back in 2024.
Okay, so he's done this before.
He has. A first-time sponsor trying to enter the digital asset space would be at a massive disadvantage. They would basically only see the deals that have been passed over by everyone else.
The leftovers, basically.
Right. Singer's established ability to source targets, execute rigorous due diligence, and ultimately close a value-creating transaction. That is the core reason Tier 1 investors are willing to hand him their capital.
Okay, so we're looking at a self-sustaining pool of capital, insulated within a trust, managed by a team with a historical precedent of closing deals. This kind of shifts our focus to how the broader market is valuing this incredibly specific setup.
Yeah, the chart on this one is fascinating.
It is, because if you pull up the stock chart for Insight Digital Partners to Second, the price action is almost completely static. Like, over a 12-month period, the stock just hovers tightly between $9.95 and $10.15.
It's essentially flat.
Yeah, it is basically a flat horizontal line right near its 52-week high. For a tech-adjacent stock, that lack of volatility seems impossible.
Well, it seems impossible until you factor in the mathematical reality of a trust floor.
A trust floor.
Yeah, so we established that the IPO capital sits in a trust account.
Okay.
That structure comes with a legal guarantee. If the management team fails to find a company to acquire, or, and this is important, if they propose a merger that you, the investor, believe is terrible, you have the absolute right to redeem your shares.
And when you redeem, you just get your money back.
You receive your pro rata portion of the cash sitting in that trust, yes.
And because of the initial pricing and the accumulated interest, that redemption value is roughly $10 per share, right?
Exactly. Therefore, that $10 mark represents a literal structural level of support. The market collectively knows that the baseline intrinsic value of the cash backing each share is $10. This severely truncates the downside risk.
Okay, let me test the mechanics of that floor for a second. What happens if, say, a massive macro event crashes the broader tech market and panic selling drags this specific stock down to, let's say, $9.70?
The underlying mechanics of the market simply won't allow it to stay there.
Why not?
Arbitrage. You have institutional hedge funds that specialize purely in finding mathematical mispricings. If the stock drops to $9.70, an arbitrage buyer knows with absolute certainty that the share can be redeemed in the future for $10 in cash.
Oh, right, so they just scoop it up.
They will aggressively buy every single share available at $9.70 to capture that guaranteed risk-free 30-cent spread. That invisible hand of institutional arbitrage acts like a vacuum, just immediately sucking the price right back up to the $10 trust floor.
Wow, that completely explains why the price cannot drop. But the trading volume on the chart is equally bizarre. Like, I was looking at a random trading session, March 20th, 2026.
And there was barely any movement, right?
Practically zero. Only 197 shares traded hands the entire day. To a casual observer, this looks like a completely abandoned asset, like a dead stock.
I get that, but we have to look past the surface-level volume to understand the psychology of the chart here. This is not an abandoned stock. It's actually demonstrating a classic, highly disciplined accumulation phase.
Okay, so it's not dead, it's just waiting.
Exactly. Analysts refer to this specific pattern as a coiled spring.
A coiled spring, so it's storing potential energy because it's trapped between the arbitrage buyers at the bottom and a lack of news at the top.
You nailed it. The downside is firmly capped by the trust floor, so it cannot compress downward. At the same time, there is zero fundamental reason for the price to break out upward until the management team actually announces a definitive business combination.
So the low volume is just a symptom of that waiting game.
Yeah, the low volume is a hallmark of this pre-deal anticipation. The market is basically holding its breath.
Right.
The moment a credible acquisition target is leaked or officially announced, that stored energy is released. The spring snaps. And that results in a sudden, violent spike in trading volume and price volatility.
Because everyone rushes in.
Exactly. That will be the technical signal that the market is actively repricing the asset from a stagnant pool of cash into a living, breathing operating business.
Okay, so if the daily volume is in the hundreds of shares, retail investors are clearly not participating in this waiting game right now. But there were over 17 million shares issued during the IPO. Who is holding all of that equity?
This is where tracking institutional sentiment becomes absolutely critical. Following the smart money provides a major clue about the viability of the sponsor.
What are the institutions doing?
Immediately following the IPO, we witnessed massive, highly concentrated block buying from sophisticated institutional players. For example, Polar Asset Management initiated an 8.6% stake. They acquired nearly 1.5 million shares.
Man, taking a position that large in a pre-revenue shell requires immense conviction.
It really does.
Yeah.
And they were not an isolated case at all. Adage Capital Management disclosed a 7.83% stake, purchasing 1.35 million shares.
That's a lot of institutional weight.
It is. We are seeing cluster buying from Tier 1 asset managers. And the thing is, they aren't necessarily betting on what the specific target company will be because they don't know yet.
Right, they can't know.
They're betting on the asymmetric mathematical setup, and they are trusting Michael Singer's network to hunt down a premium asset in the digital infrastructure space. And, we also have to consider the underwriter's over-allotment.
Well, let's touch on that. Let's define the over-allotment or the green shoe option for you listening. Mechanically, how does that prove institutional demand?
So, when an investment bank underwrites an IPO, they build in a legal clause that allows them to issue an extra percentage of shares beyond the initial target.
Right.
This is strictly to stabilize the price if demand dramatically outstrips supply. In the case of Insight Digital Partners II, the underwriters exercise this over-allotment option in full.
Okay, so that mechanically proves that the appetite from institutional capital to get in on the ground floor was just so overwhelming that the banks had to create the maximum allowable number of shares just to satisfy the buy orders?
Exactly. The demand was massive.
But, to maintain a balanced perspective here, we have to acknowledge that not every institution is diamond-handing this stock.
That's true.
Because Harrod & Circle, which is a major player, they completely liquidated their position prior to any deal announcement. So if the downside is protected and the upside is this coiled spring we talked about, what is the mechanical incentive to sell?
It really just comes down to different mandates and yield farming strategies within institutional finance. You see, some funds have zero intention of ever holding through a merger.
Really?
Never. They utilize these special purpose acquisition companies strictly as synthetic, low-risk cash alternatives. So they'll buy a massive block of shares at $9.95, park the capital, and just wait for the trust's interest yield to slowly push the net asset value up to, say, $10.05.
Ah, I see. So they just skim off the top.
Right. Once they capture that small percentage spread, they sell the block and move that capital to the next vehicle. So Harrod & Circle's exit does introduce a necessary note of caution here. It reminds us that institutional patience is finite. Some funds simply will not wait out the full search timeline.
And that timeline is the ultimate catalyst here, right? Because the smart money is parked, the downside is protected by arbitrage, and now they are just watching a ticking clock.
A very strict clock, yeah.
Yeah.
From the date of their October 2025 IPO, the management team has a hard 24-month window to formally announce a letter of intent or a definitive business combination agreement.
Okay, so by October 2027, they either secure a target where the entity is legally forced to liquidate and return the $10 per share to the investors.
Exactly.
So the only metric that matters over the next few quarters isn't an earnings report, it is the announcement of that deal. Given their mandate, what kind of infrastructure are they actually hunting for? Because the landscape for payments, crypto, and high-performance computing is undergoing some pretty massive shifts right now.
It is. We are seeing extreme distress and rapid restructuring in digital infrastructure. And honestly, this creates a highly target-rich environment for a vehicle with $170 million in deployable cash.
They can basically pay the white knight.
Exactly. They could target a distressed but highly utilitarian digital asset provider. Imagine a massive data center dedicated to artificial intelligence training that desperately needs capital to scale its power grid, but they just cannot secure traditional private equity financing due to the perceived volatility of the sector.
Oh, that makes sense. Or maybe like a regulated stablecoin issuer trying to scale its custody operations. But how does the broader macroeconomic environment impact their ability to close a deal like that?
Well, the largest looming macro factor right now is legislative action in Washington, specifically regarding stablecoin and digital asset regulation. Currently, much of the crypto infrastructure operates in this weird regulatory gray area.
Which makes traditional banks super hesitant to engage with them.
Right. Nobody wants that risk. But if Congress passes clear, comprehensive stablecoin legislation, the entire paradigm shifts.
The zoning laws essentially change overnight.
Precisely. The murkiness evaporates, and the entire digital infrastructure space is instantly validated as a legally compliant, foundational sector of the traditional economy.
That would be huge.
It would be. Because if that regulatory clarity arrives, traditional institutional capital will be forced to seek out compliant digital targets. So if Insight Digital Partners is already in the final stages of a merger with one of those infrastructure providers, the valuation premium they command from the broader market could be astronomical.
They basically become the publicly traded bridge to a newly legitimized industry.
Exactly.
Okay, so that is the ultimate bull thesis, capturing a massive regulatory tailwind just as that coiled spring snaps.
Right.
But we've got to address the structural risks, too, because that same regulatory environment is a double-edged sword.
Very much so.
Right. Because if Washington decides to aggressively crack down on digital assets instead of clearing the path, this entire structure faces immense pressure. What are the actual mechanical risks that could blow up this trade for an investor?
Well, there are two primary risks that you really have to weigh here. The first is pretty straightforward. Deal failure.
Just not finding anything.
Right. The management team could search for 24 months, conduct due diligence on dozens of companies, and simply fail to execute a definitive agreement.
But in that scenario, the trust liquidates and you get your $10 back. You don't actually lose your principal. You just suffer the opportunity cost.
Yeah, but that opportunity cost is real. Your capital was tied up for 2 years, generating zero personal return, when it could have been compounding in a broad market index fund.
Right. Opportunity cost is basically the hidden tax of a liquidation.
Exactly. However, the second risk is far more destructive, and that is the mechanics of dilution and volatility surrounding a poorly received deal.
Okay, let's walk through a mathematical hypothetical on that.
Sure. Let's suppose the management team announces an acquisition in the crypto space, but the broader regulatory environment has turned hostile, and the institutional shareholders just absolutely hate the target company.
But the shareholders still have to vote on whether the merger goes through, right?
They do. And this is where it gets tricky. Often, institutional holders will vote yes to approve the merger, just to finalize the process.
Wait, why vote yes if they hate it?
Because they will simultaneously exercise their legal right to redeem their shares for the $10 in cash.
Oh. They approve it so they can cash out.
Exactly. So imagine 80% of the shareholders opt for redemption. That trust account, which held over $170 million, is suddenly drained down to just $34 million.
But the private company they are merging with still demands the full agreed-upon capital injection to fund their business plan.
And that creates a catastrophic capital shortfall. To bridge that gap and actually close the deal, the management team is forced into highly punitive financial maneuvers.
Like what?
Well, they might have to take out exorbitant high-interest sponsor loans. Or even worse, they are forced to put millions of new shares and sell them at a steep discount to alternative financiers just to raise the cash.
Wow. And if you are a retail investor who decided to hold on to your stock through the merger, your ownership percentage is instantly crushed.
It's decimated.
You own a much smaller slice of a deeply embedded pie, and that $10 safety net we talked about is completely gone.
That is the mechanical reality of a redemption spiral. Once the merger is finalized, the trust floor evaporates entirely.
Right.
The stock is subjected to the brutal price discovery of the open market, and if dilution has occurred, the share price will crater violently.
Man, that perfectly frames the tension of this entity. You have absolute structurally guaranteed downside protection right up until the critical moment of the merger. But that is countered by massive opportunity cost risk and the mechanical threat of heavy dilution if the deal faces high redemptions.
It's a delicate balance.
It really is. So, synthesizing everything, the self-sustaining trust yield, the coiled spring chart, the aggressive smart money accumulation, and those looming macro tailwinds. What is your final verdict here?
Well, weighing the structural downside protection against the volatile upside optionality, I'd say this setup warrants a bullish score of 7 out of 10.
A 7 out of 10. Okay.
Yeah. Insight Digital Partners II represents a calculated asymmetric hold for a 6 to 12-month horizon. The aggressive, concentrated share accumulation by Tier 1 institutions like Polar and Adage, that provides essential validation that the sponsor's pedigree carries real weight.
The smart money trusts the jockey.
Exactly. The critical catalyst moving forward is the announcement of a business combination agreement. If they successfully land a transformative target in the digital infrastructure space, the resulting price action has the potential to rapidly re-rate the stock far above its current trust value.
So for you, listening right now, the decision hinges on whether you believe this specific management team has the network to secure a premium target before the 24-month clock expires. And of course, whether you're willing to absorb the opportunity cost while waiting for that spring to snap.
It's all about patience and conviction.
Absolutely. Which brings us to a final thought for you to mull over. We are watching digital assets, artificial intelligence, and high-performance computing evolve at just an unprecedented velocity.
Lightning speed, really.
Exactly. So in a sector that moves this incredibly fast, how much of a strategic advantage does a massive, highly regulated, single-purpose pool of blank check capital actually have over traditional tech giants when it comes to acquiring the infrastructure of tomorrow?
It's a great question.
Like, does this structure provide the agility needed to strike first, or will the established incumbents always beat them to the punch? Something to deeply consider as you watch this space unfold.